Okay, good morning, class. Today we are going to look at sales with a right of return and as our topic. And what does this mean? No, in a situation whereby you make a sales, but there is possibility that the customer will return part of those goods to you. So that is what this means, sales with a right of return. Where goods are sold with a right of return, the reporting entity should not recognize revenue for the goods that are expected to return by the customer. And the selling entity can calculate the level of expected return using the expected value method. A situation whereby you sold, let's say, 10,000 units of a product A, and there is a tendency that this customer might return, say, 1,000 units to you of product A. Is going to return 1,000 units of this product, so you are not expected to recognize this 10,000 as revenue. You can only recognize 9,000 as your revenue because you are expecting 10 to be returned by the customer. Because according to IFRS 15, which is revenue with a customer. So goods sold with the right of return to customer should be treated as one. We have to now be careful with these conditions according to IFRS 15. The percentage of sales value that is not expected to be returned by the customer should be recognized as revenue in the profit or loss. It is the sales. That is what I just explained here. That is the percentage of sales that the customer is not expected to be returned. You are going to recognize that as revenue. So that will be your revenue. Then the second point is the percentage of sales that is expected to be returned by the customer should be recognized as a refund liability under current liability in the statement of financial position. That is the percentage of sales return. You cannot recognize this as a revenue. That is what I just explained with that 10,000 units and 1,000 units. Then the third one is the total sales value should be recognized as trade receivable if the customer have not yet paid. That is the total sales value should be considered as receivable in a situation whereby the customer have not made that payment. That is what this is saying. Then point number 4, the percentage of the cost value or carrying amount of the goods that is not expected to be returned by the customer should be recognized as cost of sales in the profit or loss. So this is cost of sales. So the cost of sales is what the customer will not return. That is what you will now consider as your cost of sales. In this case, the carrying amount of the 9,000 unit of product E should be considered as our cost of sales. Then number 5, the percentage of the cost value or carrying amount of the goods value that is expected to be returned by the customer should be recognized as right of return asset, current assets. So that is the return. So the percentage, the carrying amount, the percentage of the carrying amount items that you are expecting from the customer, you are now to recognize it as under current asset. That in this case, you see we have 1,000. So the carrying amount of this 1,000, you are to recognize it there. Then number 6, the total cost value or carrying amount of the goods should be subtracted from the inventory. The total amount of the 10,000 units should be subtracted from your inventory. That is what this is saying. So that is how to treat sales with a right of returns. You have to familiar with all these terms, because the goods, the 10,000 units you sold, you are not going to recognize that as a revenue, because you are expecting 1,000 unit return from the customer. So, and the carrying amount of the 10,000, you have to remove them from your inventory, but the cost of sales is only the percentage expected not to be returned by the customer. That is what you will now take as your cost of sales. So I hope you understand this. Thank you so much for your time.